Welcome to the Sicart Associates September 2017 Macro Views presentation. Please take a look at our disclosure. We will explain first why we're exceptionally cautious given the macro trends that we're seeing. Today we choose capital preservation over growth and income. We believe that in the long run, the true secret to keeping a fortune is selling too early, not buying at the top. We're seeing very high valuations and very low yields, which leads us to believe that there is a very high risk to principal. And because of it, we decide to have a higher than usual cash position. We believe that there are three strong reasons to be exceptionally cautious. First of all, we see an unattractive high-risk market. Record valuations, record margins, record buybacks. We see fragile, weak growth, weak economic backdrop overall, weak earnings growth, and weak GDP growth. We also consider all available pro-growth tools as used up by central banks and governments around the world. What does that mean? We're looking at record low interest rates globally. We're looking at record high debt, and specifically in the US, but it also applies to other central banks, record high balance sheet. Let's take a closer look at the unattractive high-risk market. We included two charts that show you the performance over the last 20 years for the S&P 500 and the MSCI World. As you can see, they're both at all-time highs. This reminds us of a certain period in the past, more specifically late 1920s. It was in September of 1929 that a famous at the time economist, Irving Fisher, said, "Stock prices have reached what looks like a permanently high plateau." Today's market reminds us of that period. We've had 130 days with one single 1% drop for both the Dow Jones and the S&P 500. This is the longest period of that kind of flat market in 20 years. Since April, over the last few months through September today, we've had very few days with more than a 1% drop in either of the two major indices. I mentioned earlier how the valuations are at all-time highs, so let's take a quick look at three different metrics that will give you some idea of how high the markets are. So let's start with the one that tells us that we're looking at the third priciest market ever. And this is just the current S&P 500 PE ratio using reported 12-month trailing earnings. We're looking at a period from 1880 to today, and the current market is the third highest with a 25 times PE ratio. If you exclude the little jump in 2009, it's really the second highest. The other higher one was the internet bubble of late 1990s. When we look at the second priciest market ever, based on the Shiller PE ratio, which uses cyclically adjusted earnings, we have a 31 times PE ratio. And when we look back at the same period, back to late 1800s, we're looking at the second highest. Actually, what's interesting is that the PE ratio using that metric was at the same level back in 1929 when we experienced the Black Tuesday and the big market crash that everybody remembers. The third one, which tells us that we're looking at actually the priciest market ever, is using cyclically adjusted PE ratio that we looked at a second before, but it's divided by a 10-year average GDP growth. What it tells you is how much are you paying for the growth rate that you're getting. So in this case, we're looking at 20 times today. And the last peak was the internet bubble when it was 13 times. What is interesting is the median value for all three. So starting from the beginning, it was 15, the median over the period of the study from late 1800s to today, it's 25 today. Then for the middle metric, it was 16 times median and 31 times today. And the last one, 5-time median and 20 times today. So the market would have to drop 40-60% or more just to get to the median valuations. We mentioned the record debt and record low interest rates that helped the entire economy, the companies, the consumers, and the governments. Specifically, when you look at the profit margin of companies, when you look at the improvement that we've observed since the dip in 2009, we're talking about a 5-point improvement. The majority of it came from interest expense going down, 3.7 points. The corporate borrowing cost fell from 7.5% in 2008 to 3%, and it actually bottomed at 2.5% in 2016. A lot of companies were able to restructure their debt, refinance at much lower rates, and show margin improvement that had less to do with the real fundamentals and more with the capital structure and the lower cost of debt. When you look at the total levels of the debt for the corporate world, excluding financials, just the S&P 500, we're looking at a doubling of the levels to $6 trillion. And in terms of the ratio of debt to EBITDA, we went up from 1.25 to 2.25 in the last 7-8 years. The big secret behind the success of the stock market over the last few years was the very quiet buying of shares, buyback programs executed by companies. Those buybacks, if they happen with the use of actual cash flows, we're very happy to see that, especially if the prices that the companies pay for their shares are reasonable. But when the same buybacks happen with borrowed money, they're actually masking weak growth, and they're not sustainable. Eventually, companies will not be able to borrow more to buy back their shares and show earnings per share growth given the shrinking share count. So when you look at those two charts on the left, it shows you the S&P 500 companies and how much they spend on buybacks and how they spend more usually when the index rises and less when it drops. And we're at some record levels historically. Then the second chart shows you the contribution of buybacks to the S&P 500 EPS growth. As you can tell, the earnings growth slowed down substantially, and the impact of the buybacks was very meaningful and maintained an illusion of earnings growth over the last few years. In fact, 1/3 of the S&P 500 performance since 2009 was driven by buybacks. Moving on to the weak growth. Earnings growth and the economy are slowing down. Looking at the top left chart, you're going to see world economy slowing down. China still playing a very meaningful role, keeping up the growth rate of the global economy. But when you look at the actual growth rate, it's falling below 3% globally, even including China. Then specifically China, the top right chart shows you China's annual GDP growth that's slowing down from 7, 8, 9% that we got used to not long ago to below 7% right now. When you look at US forecasted earnings since 1950 to today, obviously there's quite a bit of cyclicality, but the trend is pointing down from about 5% to 2% over that period. Then the bottom right chart shows you corporate earnings expectations and actual over the last few years, and the trend is similar. It continues to slow down. We might be looking at the priciest market ever and possibly one of the weakest backdrops historically. So when you look at the GDP growth rate, it's slow. The productivity growth rate is slow. We have record high public and private debt. We have record low earnings growth, and we have record low interest rates. So when you compare 1995 to 1999 to the last 5 years, you will see that we have half the GDP growth rate, under 2% annually over that period. We have very weak productivity improvement of under 0.5% compared to under 2% in the late 1990s. The big difference is in the debt levels. So when you compare the federal debt that reached 20 trillion this year compared to 5.3, 5.4 back in 1999, or the personal and the corporate debt that reached over $41 trillion today compared to only 15.5 back in late 1990s. The deficits much smaller, even with surpluses in late 1990s compared to deficits today. When you look at the interest rates, it used to be a 6% interest rate on the 10-year Treasury. Now it's a little over 2%. The Fed funds rate was 5.3, 5.4 back then, and it's 0.2 today. The big difference in earnings growth over the last 3 years, 5 years, and 10 years is very visible. You can see that over the last 3 years, earnings pretty much didn't grow. And then when you compare it with late 1990s, earnings were actually growing 7, 8, 9% annually over the 3, 5, 10-year period. The biggest difference between today and any period in the past is the zero interest rate policy. When you look at the chart that covers the period from 1850s to today, you'll see that we never had a zero interest rate policy in any of the major countries. A zero rate would imply that there's no risk of default, but when you look at the long history of defaults, including the US, we've had very regular sovereign debt defaults since 1800s. The blue dots on the left side chart represent all the defaults that were recorded in all major economies around the world. We talked about the record private and public debt levels earlier, but just to give you a better idea, we included 4 charts that show you the federal debt, US government debt to GDP, total US debt to GDP, and then the balance sheet of the Federal Reserve as a percent of GDP. As you can tell, we're all at peak levels across the board. The last time we were anywhere close to those levels in terms of the government debt as a percent of the GDP or the size of the balance sheet of the Federal Reserve, it was when we were fighting World War II and recovering from the Great Depression. Record low rates and record high debt both helped inflate asset prices over the last decade. So when you look at the home prices in the US, we've seen obviously a decline from the peak in 07 through 2011, 2012. But since then, we've seen a major increase in the prices of homes in the US. And we've actually reached levels that are higher than the last peak of 07. Historically, when you look at the home values on chart on the right side, you'll see that we've seen major declines in home prices in different periods of time, and it usually takes a while for the prices to come back. Again, low rates and high debt helps inflate asset prices again, and it's not just stocks and bonds, but it's also homes. We believe that asset prices are at risk. And just as a reminder, there were many, but at least those three major big declines in asset prices. The first one happened here in the US, the Dow Jones, that between 1929 and 1932 fell 89%. Then in the middle, you have Japan, that fell 85%. It took more time, since 1989 through 2003, but it was a comparable drop in the stock market prices. And then the last one that happened more recently is the Athens market, that fell 91% between 2007 and 2012. Record high debt, record high markets, record high valuations are often followed by a big drop in asset prices, no matter if it's a pretty or ugly deleveraging that follows. We like to look at the market from both the macro perspective and the micro perspective. The micro perspective gives us more of a bottoms-up view. We did a study of 1,000 largest US stocks, and we were curious how far they are from their 52-week high and their 52-week low. We usually like to look at companies that are down, cheap, and out of favor. We find more opportunities among those companies, and we tend to hold them for a while until they fully recover and even perform beyond that. So what we've noticed that in today's market, the majority of the stocks are very close to their 52-week high. Actually, 3 out of 4 stocks are 0 to 15% from their 52-week high. 1 out of 5 stocks are 0 to 15% from 52-week low. So there are very few names that happen to be down. The names that are down, and down substantially, they happen to be permanently troubled, with businesses with high leverage and low growth. They also have a number of other issues that we're not comfortable with. So we see a shortage of new ideas, and the ideas that we tend to find are not priced in a way that would make them very interesting to us. Thank you for listening, and if you're interested in additional market commentary, including the results of our proprietary research study on market opportunities from the 2008 recession to today, please reach out. Thank you.